And so a lot of people are like, well, man, 10 years is a long time to hold. And I'm like, listen, you shouldn't be thinking about the 10 years, right? We're talking about the eighth wonder of the world, which is
Yeah.
tax-free compound interest.
Come on.
And if you've got the ability to get that, whether that's in your Roth IRA or whether that's in an opportunity zone transaction.
Hello, you're listening to Ready, Set, Go Real Estate Investing Podcast, presented by Brandon Elliott. This show will be going over all aspects of real estate investing and is intended to educate, motivate, and prepare you to take action on your first or next real estate investment. For more information, please visit BrandonElliottInvestments.com. Thank you for listening and enjoy.
Welcome back, everyone, to Ready, Set, Go Real Estate Investing Podcast. I'm your host, Mr. Brandon Elliott. Excited today. We got somebody that's been in the game since 2003, 23 years in the game, been practicing as a real estate attorney for many years, but in 2018 started actually focusing more on the opportunity zones and capitalizing off of it. Has a mastermind teaching more folks how to do this, setting up funds for you as well. And then he has his own fund as well. Went everywhere from wholesaling to mobile home parks, investing heavily and being able to set up his own fund for this. Excited to talk about opportunity zones today, because this is the main bread and butter of what he's focusing on, and allowing not only for the mega rich, this is for anybody to be able to really capitalize off of and be able to set themselves up for more tax benefits and capital gains of how to offset things and so forth. So it's going to be a great episode. Ashley, Tison, what's up, man? How are we today?
Good, Brandon. Appreciate you having me on the show, man.
Yeah, man. So you're in North Carolina right now, right?
I am. I'm in Charlotte.
Charlotte. Okay, cool. How long you been there?
I've actually been in Charlotte since 1994. I got recruited to play basketball down here. I actually transferred from the Air Force Academy to UNC Charlotte, courtesy of the Duke Mafia. My dad and Jeff Mullins were roommates when they were on the first and second Final Four team at Duke back in the 60s. And so when I needed to get out of the Air Force Academy because the basketball team was terrible, my dad made a call to Jeff Mullins and he said, man, a 6'8" guy with good grades, I don't have to burn a scholarship. He's like, send him down. So
Let's go.
I ended up down in Charlotte as a result of that. And after the first open gym, I realized that I had absolutely zero business playing in Conference USA. Zero. But I was like, you know what? I'm going to play my role. I'm going to learn from all these guys. I'm going to hustle. I got 5 fouls to invest, and I'm going to help increase the team GPA and cheer everybody on. So fortunately, I actually got to play in Conference USA, and then I ended up playing a little bit over in Germany. And when I got back from that, I ended up going to Chapel Hill for law school, and then came back down here to Charlotte to practice.
Let's go. I love that. What got you into law school?
Both my uncles were attorneys, actually, strangely enough. And then my mom was in law school when I was in undergrad. And so it was almost like I didn't have a choice, right? International business, as I was interviewing somebody, I was in my major undergrad, and they were like, well, it's great, but, effectively you're just stuck in a conference room overseas and you got a freaking 8-hour plane ride in order to get there. And I'm like, that doesn't sound very fun. So I was like, yeah, I'm going to try law school. And I went through law school, and then, when I was coming out, it was during the dot-com boom. And so, man, they were cranking salaries up, and I went to big law because I thought that was the way to go. And I let it suck my soul for 5 years.
Yeah.
Along the way, I was like, you know what? I need to feed this entrepreneurial bent that I have, though, because I've had real estate in my blood. My family's been in the real estate business since the late 1800s, timber and, other type of stuff. And I was like, I want to get into that. So I started flipping houses, wholesaling, and I actually bought my first mobile home park the year that I finished up with the big law firm.
Wow. So you were working for another law firm for the first 5 years until what, 2008?
No, so I started working in 2000. So I got licensed in 2000.
Okay.
I didn't start doing real estate law till 2003. Thus the 2003 that I've been doing real estate law since.
Sure.
But I left the big law firm and I went in-house with a commercial real estate developer and tenant and common syndicator. And so while I was doing that, I was doing, flipping and wholesaling on the side. Yep. And then just absolutely got punched in the face in 2008.
Yeah. Who didn't? Right?
I was there, man. If you didn't, God bless you, right?
Yeah.
You're the freaking black swan guy.
Right. So what happened? How bad was it for 2008 for you?
So I actually had left the tenant in common syndicator, and I'd gone out with a guy that I knew from college who had set up a .com in his dorm room.
Nice.
And I was general counsel for him, and he was a real estate developer. And we were developing a golf course in the mountains of North Carolina. It was the funnest project I've ever done, but we started that project in April of 2007. And so by July of 2008, I stopped getting paid. And, I was probably in the hole about 150 grand, relative to like current pay, and then upside in the deal that I was planning on. And I learned a couple of valuable lessons there. First is that, man, make sure you got plenty of liquidity in a deal that you're doing. Second is don't count on the upside in deals as it relates to your comp, right? Just have it be gravy. But I got stung by that. Thankfully, I really didn't have a whole lot of PGs or other outstanding real estate. And the one real estate asset that I did have was a mobile home park in Charlotte, and it actually did fairly well. And then I was able to pick up additional mobile home parks kind of as I left that, the golf course deal. But I was like, I got to go back to practicing law. And so I set up an M&A firm specifically to help kind of Main Street level, business owners take advantage of Wall Street level sophistication, but at a Main Street level price. So back in 2009, we built a software system that would auto do documents for people that were doing M&A activities.
Nice.
And so we that actually did very well. And I grew that and then sold it in 2017 because I wanted to help business owners keep more of what they made. I wanted to help them do well by doing good, namely in the form of tax savings.
Yeah, I love that. So for tax savings, like where is that from your personal experience? You were like, hey, Uncle Sam's coming around once a year and really knocking heavy on the door. Something's got to give here. Or
I've always done pretty good myself relative to like having stuff on the side and having deductions and that kind of thing that I could do. And so it wasn't that big of a deal individually, but I just saw business owners leaving so much money on the table. And I was like, holy crap, with a little bit of foresight and advanced planning, we could massively reduce the bill that you're paying to Uncle Sam.
Oh yeah.
And, the federal government is going to be the biggest vendor of your life.
Yes.
Let's cut that down as much as we can.
Yes. Come on. What examples or strategies can you give to the everyday listener right now? And obviously this isn't tax advice or anything. It's just personal.
This is definitely not tax advice. That would involve you sending me money and me then talking to you about your individual specific situation. But
which we encourage do that too. But for the time being, give me some examples that you've used in the past.
I love the layup of kids on payroll. So that's a big one. That's, almost $15,000 a year per kid right now. I think it's like 14 at this point. And I also love the Augusta rule, using your house for activities. Those are layups that everybody should be doing. I've got a solo 401k. That's been a boondoggle for me, right? Of being able to do the employer match. I actually just recently implemented a self-directed, so I've got a self-directed 401k, and I created a ROBS, a rollover business startup, so that I can use that for new business activities that I do. And when I dividend out, it goes into my Roth IRA. And then my favorite are opportunity zones, and the benefit that you get out of that, especially when you couple it up with either a change in accounting method or a cost segregation study where you're able to massively depreciate things. And then the great thing about opportunity zones is that it allows you to defer it on the front end going in. You get to run a cost seg, depreciate things, offset against the income. And then after 10 years, you get a step up in basis to fair market value that eliminates capital gains, but it also eliminates depreciation recapture. So it's really powerful.
My gosh, it's like the triple threat. Come on. So talk to me. When it comes down to anybody not understanding exactly an opportunity zone, do you mind just giving like that high level view for the listeners?
So it was created by the Tax Cut and Jobs Act of 2017. And what they were trying to do was to get the attention of private capital and to get it to invest into historically underinvested areas.
Sure.
And so they said, hey, we need to limit this for purposes of the reconciliation. So we're going to limit it to equity from capital gains. So you have to have a capital gain, but you get to take that capital gain and you get to invest it into a qualified opportunity fund. And a qualified opportunity fund doesn't have to be BlackRock. It can be your own, LLC, tax as a partnership. And you're going to defer those gains. Under the original legislation, it was until December 31st, 2026. Under the updated legislation, it's now 5 years. And if you hold on to that investment for 5 years, you're going to get a reduction. Now, under the new legislation, it's going to be a 10% reduction. Or if you're in a rural qualified opportunity fund, it's a 30% reduction when you pay the taxes on the original gain. But the big benefit is that whatever you've invested in out of your qualified opportunity fund, after your fund investment into the qualified opportunity fund turns 10 years old, that's going to be eligible for a step up in basis to fair market value. And so a lot of people are like, well, man, 10 years is a long time to hold. And I'm like, listen, you shouldn't be thinking about the 10 years, right? We're talking about the eighth wonder of the world, which is tax-free compound interest. And if you've got the ability to get that, whether that's in your Roth IRA or whether that's in an opportunity zone transaction, you need to be thinking about how long you get to hold it, not how long you have to hold it. And so that's the power of this, is that you get to hold it 30 years. And so you're able to let it eat tax-free for 30 years without tax drag and without transactional drag. And that is really, really powerful when you look at what that has the ability to be able to do from a generational wealth creation standpoint.
Heck yeah. I love that. Actually, what qualifies for an opportunity zone?
So there are approximately 8,753 of them.
Just a couple.
I can't remember the exact number on it, but and they are all over the United States. So every state, I think every county has one, and also the territories. So 98% of the island of Puerto Rico is an opportunity zone. Guam has, the U.S. Virgin Islands have them. And so if the governors got to designate up to 25% of their low-income census tracts as opportunity zones, and that's when they got set. So the original map, and you can find the map at ozpros.com/map, was set back in 2018. We are getting a new round of zones designated this summer. So in the summer of 2026, we will have new eligible tracts get designated by the governors. Those will be confirmed by the end of this year. And then under the new legislation, we call it OZ 2.0. You'll be able to invest into those tracts beginning January 1st of 2027.
Wow. I didn't realize that they were announcing more.
New ones, yeah.
Yeah. How often do they do that?
It'll be every 10 years now.
Every 10 years. So this is the next big one.
This is the first one, right? Of the new kind of designations. And then it'll be every 10 years after that.
Wow.
And so the new requirements are a little bit tighter relative to like the low income nature, because they really wanted to incentivize going into the areas that really need it. The 1.0 tracts that got designated were based off of the 2010 census. And they could also designate contiguous tracts. And so there's a fair number of them. When you kind of scratch your head, you're like, wait, that's an opportunity zone? You mean beachfront property in Myrtle Beach? Like literally the Strip is an opportunity zone? Wait a second.
Wow.
And so those are going to still be available for investment all the way till December 31st of 2028. And so you could bring in 2.0 money under the new terms with a 5-year deferral and then 10% reduction into 1.0 tracts until December 31st, 2028. It's a unique period of time where you're going to be able to do that. Then after this, the existing zones expire when the new ones get designated. And so you'll have to have a deal done before they expire.
And they're just judging off the last 10 years.
Correct.
For each one. Yeah. Okay. To see what changes. So that is a unique perspective. So when it comes down to, the owners of this land currently trying to purchase something like that, they obviously know the value. And the tax benefits and so forth. Are they putting more of a premium on it?
Well, it's funny. When they first got designated, sellers were like, oh man, I got opportunity zone property. It's worth double now.
Yeah.
And it's not, right? It is not worth double.
It'd be crystal clear.
So it took a while for people to figure out that, okay, even with tax savings on this, the buyer's got to wait 10 years and they have to substantially improve it.
Yep.
And so it then normalized out relative to people's expectations.
Sure.
The other thing is that if you own property in an opportunity zone and you bought it prior to the designation, you're not eligible for any of the benefits.
Really?
And so you actually have to transact. Now, we've got some creative ways that we can help people do that.
Yes.
But you actually have to transact. And so just having property in the zone does you absolutely zero good. You need to find a buyer that has a tax problem that wants your property. That's what, is the key. And, that's just like anything else, right? Is that, you could think something's worth $100, but if somebody's only willing to pay you 10 for it, then it's worth 10.
You could technically sell it to another LLC that you own, right? And file it and...
No, there's a related party lockout. Now, we can get around the related party with a third party ground lease, but it's a fairly significant lift in order to get around that. And so the IRS was fairly smart. They were like, all right, no related parties on how you generate the capital gain, right? So you can't take that hand turkey that you made back in kindergarten and sell it to your mom for $1 million and, have that capital gain that way. And then you also can't sell property to a related party. So you couldn't transfer it into your own QOZB.
That makes sense. Yep. Talk to me about the improvement requirements. What does that look like?
Yeah, so they wanted people to not just go and sit in the land bank. They wanted they wanted activity to happen in the zones.
Sure.
And so they required it to either be original use, so that it's either ground up or vacant building qualifies, where you're actually putting something into use for the first time, or rehabbing it from when it wasn't in use. Or if it's got an existing building on it, you have to double the value of the building, and you can exempt the land out. Now, if it's in a rural qualified opportunity zone census tract, you only have to do 50% of an increase in value. And so they wanted to give incentives for people to go into rural areas as well.
Okay. What is the most difficult part about jumping into some of these opportunity zones?
I think that what's funny is that the greatest part about the program is that you don't have to ask for permission from anyone. It's an as of right program. So if you have capital gains and you're buying a deal in an opportunity zone and you do it correctly, then you're good to go. Now, the nuance is that you need to know how to do it correctly. And it's not that hard, but there's definitely nuances to it that can really mess you up. Okay. And if you mess up, right, there's some pretty substantial penalties that you're going to get hit with. And so that's the key thing that people need to pay attention to. And that's kind of the hardest part, is the nuances, and then making sure that they're keeping a really good audit trail.
Okay. What kind of consequences could somebody anticipate if they did it wrong?
So if they fail to report, they can get, it could be $500 a day, up to $10,000. And then if they fail to meet the 90% standard, then it's basically the underpayment rate for however much they're underneath the 90% standard. So when you put your money into a QOF, you got to invest 90% of the assets into opportunity zone property. Now that can be through a qualified opportunity zone business. That's one of the other great things, is it's not just limited to real estate. You can actually invest into businesses in the zone. But inside of that 90% threshold, if you miss that, then you get hit with the underpayment penalty for however much you miss it.
Sure.
And so, in 2025, the underpayment rate, I think, was 7%. So it could be, depending on how much you've deferred into your fund, that's $1 million. 7% on $1 million is, that's a lot of cash.
Yeah. Talk to me. You just said something about investing into a business part of it. Fun. So tell me more about that.
Yeah. So one of the other great things about the program is that they wanted to open this up to not just real estate deals. Yeah. So you can have any kind of capital gain on the front end. So that could be long-term, short-term. It could be from the sale of real estate. Yep. It could also be from the sale of crypto, sale of business, sale of stock, sale of gold, sale of an appreciated baseball card, anything.
Wow.
Then you can take that, you put it into a fund. The fund's got to invest 90% into qualified opportunity zone property, which could include a business. And so you can invest into an operating business that's doing business in the zone. That 50% of its income comes from a trade or business that's happening inside of the opportunity zone, which is based upon where your employees work, not where your revenue is generated. And that's going to qualify. So I've helped bakery. I've helped a guy buy a bakery in an opportunity zone. We've helped people with like equipment rental deals operate in an opportunity zone. For folks that have a big fleet, they were able to put their fleet into an opportunity zone business. And the great thing about the opportunity zone program as well is that once your fund investment turns 10 years old, you don't have to hold the assets for 10 years. So when your fund investment turns 10 years old, everything that you own downstream is eligible for a step up in basis to fair market value. So you could conceivably have a fleet management company in the opportunity zone, and you could buy vehicles in year 10, sell them in year 11, depreciate them fully, and not pay any depreciation recapture.
Holy cow. Let's go.
Yes.
So
Let's go.
Yeah, let's go. Come on. So you mentioned something about like crypto, and it got me thinking, like, can you put somebody in the location of an opportunity zone and still manage a crypto account and still qualify for something like that, or no?
So technically, yes.
Yeah, it's like it.
I think you got to, so inside of the legislation, they had rules for substantial abuse.
Sure.
And if you're just doing crypto, right, where you take your gain and you put it into a QSEB and you have somebody that manages a portfolio inside of the opportunity zone where they're literally just buying crypto and then maybe staking it or something, I think that you're going to, you're just inviting getting punched in the face by the IRS substantial abuse fist.
Yep.
And so I would not recommend doing that. Now, we've had folks that are actually have like mining operations inside of the opportunity zone.
Yes.
And they're employing people with that mining operation.
Yes.
We also have people that are using the crypto as part of a business incubator to teach people about how to do business. And the people go to the incubator inside of the opportunity zone. It just so happens that their business is crypto related.
Yes.
Something like that. Okay. Right.
Sure.
Like that fits inside of the intent of the program.
Yep.
Just buying crypto, got to be careful about that.
Yeah. Okay. That makes sense. I love that. I'm glad that you brought those up too, to have a, another perspective. What else are we missing on opportunity zones? Why aren't more people taking action in this?
I think that there's a couple of reasons. When the program first came out, so there was a number of things at play. First was that the financial advisors heard a gigantic sucking sound out of their assets under management. And they were like, holy cow, you don't want to go in opportunity zones. Those are less than desirable areas.
Yeah.
I actually had a guy who was a financial advisor, and I had one of my really good friends and clients. I was like, hey man, you need to look at these. And so he went to his financial advisor, and his financial advisor was like, oh man, you don't want to do that.
Yeah.
Because
that takes all the money from me.
Yeah. Those, well, that's exactly. So it's funny. He's like, those are bad areas. And then literally 9 months later, when his platform, right, that he's on got their own opportunity zone fund, he's like, hey man, he's like, I know you're in the opportunity zone world. I got this fund. If you got any clients that are interested in investing in it, I was like, dude, really? You're that obvious?
Yeah, come on.
So yeah, I think that was the first thing. The second thing was that because it was a short window, most wirehouses were like, you know what? We're not going to invest in the infrastructure to teach people how to actually do opportunity zones.
Yes.
It's too short a period of time. And so we're not fooling with that. And so I think that those were two of the big reasons why it didn't get like mass adoption.
Yep.
Now that it's permanent, we are flipping that on its head. I got all kinds of family offices that are calling me and being like, hey, listen, now that this is permanent, we need to know this, because we're able to eliminate at least 24%, drag on our investments.
Wow.
And then I've got lots of financial advisors and wirehouses that are doing the same thing. They're like, hey, can you educate our folks so that way they know this stuff so that they can recommend it? And that's financial advisors. And then that's especially CPAs and attorneys that are dealing with any kind of like wealth management or trust and estate. One of the other hidden benefits of OZs is that it effectively works like a poor man's irrevocable trust, because when you die, the only amount that goes against your estate was your original investment, not what the amount is as of the date of death. Yes. And so your estate steps into your shoes. It's one of the few vehicles that allow for that to happen.
Wow. That's incredible. I remember for me personally, like 2017, 2018, when it came out and started becoming a little bit more popular, to me, it felt almost complicated of where the locations, whether or not qualified or not, and then afterwards what to do with it and so forth, and the map and so forth. Some of it here in San Diego, it was like some of it it was incorrect, and so had to like fact check it afterwards. And so that was just one of those things. It's like, cool, do we try cherry picking in these little pockets? It's kind of unique.
Well, I mean, some of the areas that got designated in San Diego, you're like, whoa, wait, that's an opportunity zone?
Yeah.
So exactly.
It's like, is it true? It doesn't seem like it would be.
You're like, wait a second. There's no way that can be an opportunity zone.
And it's awesome and a unique situation, very smart, but how every 10 years they're going to recalculate it. And
correct. They're going to get redesignated.
Yeah. Which makes sense. I love that. Talk to me about the investment type of returns and projections. I know you talked about the family offices, what they're seeing, what they could be saving and potentially capitalizing off of, but average investment opportunities that you're seeing within your fund and returns and so forth. What does that look like?
Yeah. So our minimum investment's $250,000. And we have we issued one dividend based upon a boat and RV storage deal that we bought that was existing, and we're adding solar to it. But the anticipated returns on our fund, we're forecasting that it's probably going to be around a 15% IRR with like a 2.5 multiple on our individual deals. And each one of our portfolio deals are usually around that amount, right? Where we're not going to do a deal if it's going to give us lower returns than that. And
doesn't make sense. Yeah. With all the time, energy, efforts, and putting other people's investments at the line. So when it comes down to solar, are you guys just buying that yourself flat out, or are you guys leveraging that?
Yeah. So no, it's definitely leveraged, and it's leveraged with a finance company that funds the manufacturer. So we made an equity investment through our fund into a solar manufacturer. And so we've got kind of first option on the deals that they're doing. And so we have kind of pioneered this concept of where we get the dirt ready, and then the third-party tax credit buyer comes in and installs all the vertical. So they install containers, and then they also install the metal frames with the solar on top of them that is eligible for the tax credit. And we then rent that back from the third-party tax credit buyer. So works well for us because we get canopies and we get containers basically at no cost to us. And then, we also get a solar dealer placement fee that's equal to 27 months of current pay. And so they basically pre-fund the interest that we're paying on it. And and so we're able to step into a built facility without having to borrow it ourselves.
Man, I love creative, savvy type of opportunities like that. That sounds sexy to say.
This one's definitely out of the box, right?
Yeah, like, come on.
And I got to hand it to Justin and the team at Fortified relative to how they put that together. And they're working on some cool stuff as well, where we can do the same with cash flowing deals, right? Like in the industrial space or storage space, as opposed to developing them from scratch. So if there's anybody out there that is selling, industrial or a self-storage at, a 7 cap or under, we would be interested in looking at putting solar on top of it.
Come on. I love that. Talk to me. What does the future look like for you guys? Where are you guys heading? What's the goals, plans?
Yeah. So the big thing is that we've got a massive tsunami of people that have taxes that are coming due at the end of this year from the gains that have been deferred since 2018. And so we are specifically helping those people to look at how they can, further mitigate those taxes. So we've got a review that we're doing, and we're scaling up so that we can do that in mass. And then once we do the review, we actually help people execute it and make sure that they're getting a really good audit trail in it. And that's kind of our special sauce, is that we help people build audit trails to make sure that it's tight. And then we plug them in with kind of, really creative out of the box ideas. But instead of just being like, oh, hey, you should check out, the freaking Forex, trading platform, tax mitigation du jour. Instead of doing that, we're plugging them in with vetted deals and with vetted operators that are going to be there in order to make sure that you get white glove service on it. And that's kind of the next stage of what we're trying to do at OZ Pros.
Man, that sounds fantastic. I love that. Man, this is a great episode right here. How can the listeners get connected with you? And also, is there anything, you just gave 40 some minutes of your time, anything that the listeners can do to give back to you or myself?
Well, I think that the biggest thing that would be for me, right, relative to how somebody could give back would be, just getting involved, right? Like being intentional about, number one, doing well by doing good. Right. Yeah. Inside of that, there's so many different variations of that about how you can get intentional about what you got going on. Right. And so, one of the big things that we're trying to help people do is to look long and hard at what they've got in place relative to an estate situation and make sure that it jives with what you think that it's going to do. Yeah. And then that you've gotten your people, right? Like whoever your next trustee or whatever, that they know what your estate plan is and they know how to get into your stuff. Yep. Right. So I just went through that whole process myself based upon this one pager that this guy who's in my mastermind put together. So if anybody's interested in the one pager, they're interested in this type of stuff, we've got these resources available inside of our mastermind. And I'm really passionate about that because there's so many people that end up just dealing with unnecessary morass because they don't actually freaking log in and get their stuff squared away. Sure. And so that's what I'm passionate about helping people do, and particularly inside of opportunity zones.
And you still have your law firm active and open. Other people are kind of running that.
Yes, exactly. Okay. Well, and it's all kind of, everything I do is kind of in line with the personal brand. Sure. And so I used to silo it, right? Like where I had the law firm and I would go into the law firm like on Mondays or whatever. So, and then it was like I was dropping the ball there and it was taking too much time. So we switched that to where now my aggregate team serves my clients. And then if we need to bring the law firm into the mix, we can, but we just do it out of kind of our umbrella organization called O's.
I love that.
Yeah. And that works out really well.
And again, how can people get a hold of you?
Yeah. So if they go to ozpros.com/podcast, and inside of your show notes, we've actually got a special link, right? Where is a landing page just for your listeners where we've got some special opportunities for them. They can schedule a strategy call with me. They can join the mastermind from that. Or if they've got a fund and they want to do a review, we've actually got an immediate on-ramp to be able to make that happen. So ozpros.com/podcast. If you want to get a hold of me directly, you can email me at ashley@ozpros.com. But we're here to serve, man, and we'd love to help your listeners out if they've got any questions about OZs.
I love it. I love it. Guys, Ashley is a wealth of knowledge, been doing this for quite some time now and has it locked in. If you guys want to jump on a call with him and just network a little bit and see if there's a good synergy, good fit, then I encourage you to do that today. Right now. If you guys want to get a hold of me, you can always do so. Follow us on Instagram, Brandon Elliott Investments, as well as Credit Counsel Elite is our business page on Instagram. Feel free to follow us on there and you can simply DM me over there. Also, if you are looking for funding, I'm talking up to $500,000 with rates as low as 0%. We can show you how to get up to 90% approval odds when following the process strategically. So check out creditcounselelite.com. That's creditcounselelite.com. Would love to be able to serve you guys there. Otherwise, make sure you hit that subscribe button to Ready, Set, Go Real Estate Investing Podcast. We will catch you on the next episode. Till then, thank you and God bless. Ashley, thanks, brother.
Thanks, Brandon. Appreciate you having me on.
Thanks, man.
This has been another episode of Ready, Set, Go Real Estate Investing Podcast, brought to you by Brandon Elliott. For more information, please visit BrandonElliottInvestments.com. Also, please don't forget to like, share, and leave a comment below. Thanks again for joining. Until next time, God bless.